the world we're living in today under the present administration and the policy setting is highly uncertain. And there are a number of paths that the economy could take and the markets could take with them, right? And some of those are very good. Some of those are not so good.
Welcome to the ETF Experience Podcast, where we dive into markets with a rhyming twist today. It is April showers bringing May's flowers, but will equities bloom in May's sunny hours? Helping me to dive into this rhyme, joining us are two experts from our public equities research team here at TD Asset Management. Juliana Faircloth, Vice President and Director on the Public Equities team, and Vitaly Musinov, Head of Fundamental Equity Research. Welcome to the show, guys.
Thank you for having us.
Thank you.
So let's dive right in. We've got a U.S. stock market that's been lagging, a correction that's shaken things up, tech has cooled off, and Trump tariffs throwing a curveball into the global economic picture. Markets have experienced a sharp decline following President Trump's Liberation Day tariff announcement, sending the S&P 500 down, contributing to a roughly 10% decline over the last 2 days. The Nasdaq even entered bear market territory, down over 20% from its peak. All this quickly turned around on April 9th when Trump paused most tariffs, except those on China, for 90 days, leading to a historic rally. So, Juliana, that was a mouthful. You have the top of our house views leading our equity research team. What is your take on the big market swings in 2025?
Sure. Well, it's been quite a year. You just shared a lot of content and we're not even halfway through the year. I think for us, it's helpful to rewind back a little bit further than the beginning of 2025, because there's a lot to reflect on in the last couple of years. So if you told us 5 years ago when it was March 2020, we were all sent home, that the S&P 500 would double over the next 5 years, I think we'd probably laugh and not believe you. We've had a very incredible 5 years in the market. The S&P 500's been up 20% 4 of the last 5 years. That's been incredible. It's been underpinned by fiscal and monetary stimulus, by a really strong consumer backdrop, and by very resilient corporate earnings. So earnings have grown 60% over the last 5 years. So that's the foundation we're working with. 2025, as you mentioned, is looking quite differently. And I think the key word for this year has been uncertainty. We have a new administration, radically changing policies, overhauling the global trade order in a matter of a few weeks and days. And markets don't perform very well in uncertain times. Investors look for predictability, and that's what gives people comfort. So as a result, we've seen, a ton of volatility, and that uncertainty is playing out in many different ways.
Yeah, we've seen, some of the big companies in the U.S. pull out their earnings revisions because we just have no idea what the next day holds, right? So how should investors be thinking about these uncertain times, right? Is it an opportunistic time to get back into the market, or should we pull out? Like, having the top of the house views, how should you navigate these times?
Well, Juliana went back about 5 years. I think there's some sense to going back even further. Go back a century and just reevaluate what is the record of the market. And the record of the market is that there are periods of doubt. The market is really a pendulum, as many investors have commented. It swings from greed to fear, and it's always moving in one direction or the next. And arguably, we've hit a really high degree of fear on that pendulum. And if you look back at that last 100 years, you see a record where that's happening again and again and again. And what the history of corporate America and markets would tell you is that those are typically in the vicinity of where markets present attractive entry opportunities. So we know that U.S. corporate earnings typically compound 9-10% or so over the long run. That's the long run record of the market. Whenever you have big corrections of 15-20%, whatever it is on any given day, it's quite a lot of volatility that improves your probabilities going forward of getting a return. So long, again, as you have the right time horizon, that long-term time horizon, if you're really investing. If you're doing something else, if you're speculating in securities, that's, of course, a completely different conversation for a different podcast.
So as we've talked about, there's chatter that we may be entering a market correction. You kind of touched upon this, but do you think this is a healthy pullback or something that investors should be concerned about, given that, there's talks that this could be a man-made Trump recession?
Well, the last answer I gave, I hate to kind of go back and say let's say the exact same thing again, right? But a healthy correction, it's a little bit difficult to define that exactly, right? Every correction, of course, to the psychology of the investor feels painful, right? You look at your statement, you look at the screen of your smartphone, and you're down, right? On the other hand, as I said, whenever the market is down, it's presenting a lower price paid per unit of earnings, right? It becomes mathematically a more attractive entry point. I think pivoting that conversation a little bit to just the man-made recession and the impact of policy today, undeniably, these are times, at least for this generation of investors, that are unprecedented. You have the policymakers of the most consequential economy in the world that are acting in a way as to create a lot of possible outcomes, far more than just a binary spread here. And some of these, of course, could mean very bad outcomes for the economy, for employment, for consumer spending, and therefore for the market, right? But when that pendulum is swinging, as it did just a week or two ago when we saw the VIX, and a reminder to the audience, the VIX is that measure of really fear and greed in the market. It is the next 30 days expected volatility for the options markets. And we saw that VIX rise way above 50. I think the reading might have been even 60 Chiara. Now, you've only seen readings at those sort of levels very infrequently. For example, a reading of 80 or so, that's the record. And that you'd have to go back to 2008. And the height of the pandemic went, it was over basically, right? It was over, not just for the markets, but for humankind. And so that just gives you a sense of how fearful the markets were. And that, of course, then you see that demonstrated in the magnitude of the correction. We went into a full blown bear market there, down 20. And so you piece those together and you start really asking yourself, well, everyone's panicking. Where are the opportunities?
And it's almost, in simple terms, we could say you're buying your favorite clothing item at a discount. So are there any trends or surprises that have caught your attention since the beginning of the year?
Lots.
Maybe I'll start with just a trend that talked about a little bit already. The consumer's been a huge driver of market growth over the last 5 years. And that has played out through a number of different kind of industries and themes. Like luxury was very strong for a good period of time. We've seen a lot of change in consumer behavior. Consumer sentiment has really dropped off a cliff, just the same way that markets don't like uncertainty. Consumers also don't like uncertainty, and people are feeling cautious about their spending. So the way we see that kind of playing out in the market is through sort of a consumer bifurcation where, the people on the very high end don't feel necessarily a lot of impact, at least at this stage. But you're seeing a lot of trade down through kind of the middle income consumer and into the low income consumer. So some interesting opportunities for, retailers that skew a little more low income, maybe moving away from some consumer services. Airlines have started reporting. We've already heard some, more cautious commentary from Delta. Air Canada's commented about cross-border travel, which is, partly consumer confidence, partly that buy local, buy Canadian. But that's been an interesting trend unfolding over the last few months.
I want to dive deeper onto corporate earnings, right? We know we are coming onto earnings season, but mind you, all of that is still backwards looking, right? It doesn't take into account what's happened in the last 2 weeks, which has a huge impact. We've seen Walmart pull their earnings revision. So how is you and the team navigating that?
The beautiful thing about the market, of course, in that pendulum of fear and greed is that at maximum fear, especially as we would have seen with the market down over 20 on those headline tariffs, at maximum fear, the market is discounting the state of the future. And it no longer believes the earnings that may have been published, the forecast that companies took the time to publish at the beginning of the year. So a lot of it, you could say, is already in the price. As far as how the team is navigating it, it's exactly figuring out what's in the price. And the only way you can figure out what's in the price is doing the really difficult work. And so we have one of Canada's largest fundamental research teams, over 20 analysts that are experts in their respective domains, whether it's not just consumer, but we have somebody that would be an expert specifically in transportation. Julianne actually is one of those experts, among other things. But then in areas like AI technology or something as distinct as, let's say, hotels or other areas of travel. So getting into those financial models and understanding, well, what is the degree of resilience to various, let's say, sensitizations to the demand environment? What is the impact of tariffs directly, of course, on supply chains? What are the characteristics of that business in order to, say, exercise pricing power as maybe needed during an inflationary period? We could go on and on and on, right? But really, it's the hard work to figure out what's priced into a security. But it has to be done at a bottoms-up level with a lot of deep work done by experts, long, grueling hours at the office.
Pivoting a little bit, we hear the saying often, sell in May, go away. April showers brings May's flowers. And after all, we are an asset manager. So is there any data that supports this? And does this still hold any merit today?
So they're interesting little kind of catchphrases, right? There's a interesting history to sell in May and go away. It's actually very long dated. It goes back to English high society in the 18th century. For us, whether it's sell in May and go away or a Santa Claus rally or the January effect, these really feel more like novelties than any sort of real rule of thumb or true investing strategy. Vitaly was mentioning earlier, the S&P 500 on average in any given year is up 9 or 10%. So whether you're choosing to sort of speculate around some sort of seasonal trend, that's sort of one strategy. You can go with that. If you're looking to compound your wealth and really build up your wealth over time, then I think the catchphrase should really be time in the market, not timing the market. And if you decide to sell in May and go away, we wish you luck in getting back in at the exact right time to make that trade worth it. But for us, the compounding effects of the market over a long period of time are far more attractive and a much more effective investing strategy.
If we all had a crystal ball, we wouldn't be where we are. But I really want to focus on the risk to investors, right? Like we hear these rhymes all the time, but at the end of the day, that's why, financial advisors exist to help you stay true to that financial plan. How hard do you think it would be to time going back in? I know you kind of alluded to that, but I really want to hone in on the risks that are associated with following these trends.
Well, I think the risk is enormous, or let me just flip that and say the probability of timing this correctly is incredibly low. That's true for any set of market conditions. But unless you have access to, I think, the president or his administration right now, this is just kind of a very foolish exercise. And so there's not much more to add than what Juliana said here about time in the market. And just maybe there is one thing to add. It's of course time in the market as we see it in the right securities, right? And this is the benefit of having that research and being able to have an opinion on if the world does go into one of the many adverse scenarios that we can forecast. Well, we plan for those, right? And so under those adverse scenarios, what would the portfolio look like? And that often looks like it's often constituted from different securities than, of course, it would look like if we see the market going up. And so that kind of rigor and the work required behind the scenes is quite significant.
I would maybe just add on to that. Our philosophy as a team, we try to lean into long-term secular trends that have, a durable path of growth over many, many years. And so I think that philosophy lines up really well with a time in the market versus timing the market type of strategy, where, what our team does on the fundamental research side is look for companies that have exposure to these long-term, slow-moving thematic trends that will drive long-term growth and tap into that through investing in really high-quality companies that have a competitive advantage. They have a strong competitive moat. They generate a lot of free cash flow. We believe the market's not valuing that free cash flow correctly. And so that's the sort of philosophy and rigor behind building a long-term, durable, resilient portfolio.
So lots of strong balance sheets, I hear. As we focus on some trends, I know we have a team of 20 plus analysts working really hard trying to find these trends. Apart from focusing on tariffs, what are some emerging trends that, really excite you and the team? Is it AI? Is it the AI infrastructure bill? Talk to me.
AI is hard to ignore. And we were just before the show talking about the fad that's sort of overtaken society with the Studio Ghibli animations. And I actually noticed my mother-in-law now changed her display picture on online to be that animation. But AI, I think, has been a little bit forgotten now by the investing public, right? Because tariffs, of course, there's only so much mind share that we can have, and tariffs and politics, and they've completely come to dominate the worldview of investors right now. And it's creating opportunities because it's making the markets really sell stocks and ignore themes, namely the AI theme, that we believe is in its early innings and is going to be a massive wealth and value creation story for society as a whole. So, that's one. We kind of all can approach it in different ways. But of course, whether it's infrastructure or chips or software, across that supply chain, you're seeing these stocks get hit very well. That almost if you were kind of unassuming and just looked at the markets today for the first time, you'd say, what AI theme, right? I don't see it reflected in the stocks, and that gets us excited because, as Juliana said, that when things fall, it means you're getting a better value for something. And when you get a better value or great value for things that are literally transforming the world, that's fantastic.
And do you still find there's opportunity in that second derivative trade of AI in the infrastructure build?
Yes, but it depends which part of the infrastructure build. I think, Juliana, I might turn it over to you because a lot of these sort of infrastructure adjacencies are something you're very familiar with.
Yeah, I think a lot through 2024, let's say, a lot was swept up into the AI trade where it became, all of the picks and shovels and all of the power generation was all looped into the same trade. That was sort of an interesting period of time and made sense because AI was a sort of longer dated growth driver for all of these companies. I think if you look through some of those picks and shovels, there's still some really interesting opportunities where, valuations probably became too extended through 2024, but you still have a really interesting medium to long-term growth story for electrical content or for some of the engineering firms that build out these large infrastructure projects or help sort of step up CapEx across utility companies that provide the power for data centers. So it's still interesting. We're kind of picking our spots more selectively there, but an area we still see some opportunity.
So where do we see the market headed in 2025?
Billion-dollar question. Trillion-dollar question. I think it goes back to what we've been talking about throughout this podcast, which is the world we're living in today under the present administration and the policy setting is highly uncertain. And there are a number of paths that the economy could take and the markets could take with them, right? And some of those are very good. Some of those are not so good. Now, we're lucky to be filming this actually now mid-April, I'll just call it broadly without declaring the date. And I say we're lucky because the markets also had I think, quite a definitive declaration from the administration in terms of how far they'll go, right? Where they'll respond to market forces, where they'll respond to pressure as things begin to kind of crack under the stresses that they impose. And that's critical because we talked about that pendulum of fear and greed. And what we saw with that peak uncertainty was just the kind of the market, the floor just falling out of the market, people going to sell everything. There was a real capitulatory nature to those days, right? And now that the administration has responded and said, okay, I think the line might be here, that gives the market a little bit of relief. Now it's still down. There's still a lot of bad and good things that could happen. But the optimist in me says that is a great reprieve that we receive. Now we can take our eyes off of the uncertainty and begin again to do what we do very well, which is position our portfolios with some of the best companies that we can find right now on sale to make resilient portfolios for our clients.
Yeah. So it sounds like there's a lot more bloom over doom. Is there any final thoughts you want to leave our listeners with today?
You might not like me for this, but I'm going to hammer home the same message that we've had throughout this podcast. And it's that in these extremely difficult, uncertain times, the value of professional management is greater than ever. And what we're doing day to day is rigorous work to really understand how hundreds of different companies would perform in a variety of operating environments. So I can't sit here, and I don't think anybody can, and tell you that May is going to be a great month for stocks, or July is going to be a poor month for stocks, or that GDP growth can even be 2.1 or 4.1 or whatever. But what I can tell you is the process that we follow, we have been following it for decades, and it has led to a certain set of results. There are no guarantees in the market, but what we can promise to our investors is we're going to keep following that process with the same rigor and diligence that we always have.
That was a great way to end things off. Thank you so much, Julian and Vitaly. Thank you both for sharing your experience. It is clear that while April showers are here with tariff and economic challenges, May flowers could still bloom for us savvy investors.
If you enjoyed this episode, be sure to follow us on your favorite podcast platform and share it with friends and colleagues who love staying informed. A big thank you to our team behind the scenes, Marko Vidovic for producing the podcast, Bianca Sampson for keeping the conversation going online, George Subotic for making sure the podcast reaches you, and Anna Bita for crafting the copy that brings it all together. The views and opinions contained herein are those of the participants and do not necessarily reflect the opinions of and are not specifically endorsed by TD Asset Management Inc. or its affiliates. This is for information purposes only and should not be construed as financial, legal, tax, or investment advice. It is not an offer to buy or sell or an endorsement, recommendation, or sponsorship of any entity or security discussed. Commissions, trailing commissions, management fees, and expenses all may be associated with fund investments. Please read the fund facts and prospectus, which contain detailed investment information before investing. Funds are not guaranteed or insured. Their values change frequently and past performance may not be repeated.